Luck.
Hey guys, just open it up here. Give it a few minutes as usual for people to join the room. I don't know how many people are joining on YouTube these days, or they actually come into the webinar. Seems to be a little bit of both. So we'll give it a few minutes. Let's see. So if I go to, I'm sharing one screen. I guess I don't see comments here on the YouTube side. I think there's a few of you trying to get in on the team. Playing the Euro short. I'm still a little bit short Euro Kiwi. I don't know if you guys are also. I mean Euro versus the dollar. All right, I'm going to get started sharing my screen. So you guys, normally I make this, sometimes I have a certain topic with a lot of ground I want to cover. Today we just kind of keep it a little bit more casual. So if you have questions, you can just pop them in the queue, and then do my best to see it. So today I'll just tell you what we did in the room today. So my traders We came in today. It was pretty slow. I mean, the entire market already trades like it's summer. But we came in and sold this high right here. Let me zoom out. It's like very little movement. We sold into the highs here on right into this. This was right. I think ISM. We had a number here, but right after that we sold short, and this is literally all the movement we've had today. But we did well with what the market gave us. I mean, there's probably a lot of traders that sold the market down here. Right after the number, they read the headlines. They say, oh, better data, dollar up, Fed's going to be more hawkish, euro down, sell the euro, and they end up selling the lows. That's what happens when you chase the headlines. That's what happens when you don't trade with the cycle, right? When you don't factor time into your model, that's going to happen a lot. So we didn't short there. We sold most of our size right here. And then over here on dollar Swissy, if you guys can see this. I might need to refresh. So here this morning, this is what I was talking about on the euro. Okay. Right after the data, if you're selling on the headlines, you sold the low. Congratulations. If you're trading with time, the cycle piece, all right, this kept you out of that trade. We sold most of our size right here on the back side of this, what I call the right-hand side of the chart. And then pretty pathetic move lower, but that's all there was. I mean, that was the right thing from a timing perspective. It's just the market's pretty dead today. And then we sold into here, covered into here. I put another small piece out up here that I'm going to try to keep an eye on while I'm talking here into this afternoon. All right, guys. So the topic, I mean, I don't want to spend too much time on the model, but really kind of go through the psychology of trading. So most people just focus on technical analysis or fundamental analysis. Fundamental analysis is the oldest style of analysis or research. Technicals came on the scene late 70s, 80s, and everybody pretty much has some skill set right now in viewing technicals. And so what we do, which really separates us out, is we focus on the timepiece, right, in the cycle. So that's critical to really helping you move yourself from the land of, break-even trader or trader that's deep in negative territory, but really moving to that land of consistent profitability. And so the timepiece is key. And then the other form of analysis, which I call mental analysis, which has to do with the psychology of trading. So that's what we want to talk about today. And we were working on this on Monday. It's a lot of the same topics. I'm just going to expand on it a little bit more today. All right, so let me just bring a couple of these slides up. There are a few more people in the room now. That's good. Andrew, Craig, Rio, you guys hear me okay? Good, right? All right. So what we talked about in the room Monday, was this idea that we want to be focused on our rules and then focused on our expectations. And what we actually want to be is rigid in our rules and flexible in our expectations. And I'll get into what I mean by expectations. I'm talking about the expectations you have on the market, and why that's important is because of the emotional piece that gets wrapped up in when you think the market needs to do something or you want the market to react a certain way, it sets up a whole emotional state where you're going to be let down, you perceive information wrong. But I'll get into that at the end here. What I wanted to first talk about is probabilities. And so when you understand the probabilities, that's going to help you with your emotional state. And so probably the best example of this is in the casino world and gambling, is this concept, right, of understanding the sample set. So the parallels between trading and the parallels between gambling is that the gambling industry, the casinos understand, right? It's not about each individual hand. It's not trying to figure out what the odds are on the next hand or the hand after that or whatever it is. It doesn't matter the game. What the casino cares about is the overall sample set, right, over the long term. So I don't know what the latest figures are, but last I kind of looked into it is usually the casino's edge is about 4.5% on the dollar, right? So that includes that 4.5% figure they get from doing all their statistics and looking at their data. But essentially that includes everybody that's walked away from the table, right? Everybody that's won. And so if there's $100 million wagered, that's 4.5 million for the casino. And so when we think about that in terms of trading, it's very similar. And why that's important is because we don't want to be so focused on the particular trade at hand, right, guys, or the edge that you're looking at. Because if you're always trying to figure out, all right, is this trade going to be the one that works, or I need to be right on this trade? My last 5 trades sucked. I'm on a bad losing streak. I need this trade to be right. You're always going to be trying to look for more information to keep you in that trade or not take that trade. And what ends up happening is you end up passing on a trade that ends up being the big winner that helps you get back the last couple losing trades. So keeping an open mind is key. And then that's the same as the casino. They understand that. They just want people playing a longer term. They just know they need a large enough sample set, and that's their edge. So what we want to do is look in the markets the same way. We want to figure out what's our edge. And there's lots of different firms that do that. Some firms have, they develop different models where they find an edge and then they execute on that over a large sample set. But what ends up happening, right, is over the long term, you start to see, even though each individual play has a random event, right? If you're at the poker table, you don't know, all the random variables are the deck, the shuffling of the deck, right? If we're playing the roulette wheel, it's a spin. All those things are random. And each individual event is random, but over a large sample set, again, you're going to start to see patterns. And it's the same thing in markets. So we've identified certain patterns, right, guys? We know what to look for in certain trends. We know what's likely to happen around the pie line. So we use all that to get our edge. And then that's kind of the difference between the micro level and the macro level. Again, on the micro level, there's different variables, I guess, is what I'm trying to get at in the markets. And so, those variables are mainly the other players. You don't know who's playing in the market today. You don't know what size position. You don't know if the central bank's in a certain market or they need to liquidate. Each day is different. So every trade is completely random. And once we kind of once we start to really understand that, that's going to help you with your mindset. So let me go to the chart and we can talk about some of this. You guys with me so far? This is a lot of what we talked about Monday. But so what we want to you always want to be identifying the edge, and you want to get good at that. And that's what the model helps you with, right? We learn to identify where you're going to get a lower high potentially. But the key, the right mindset is to say, okay, I know that where the edge is. I know where probably the market has a good chance of failing, right? There's good probability here that we're going to get a lower high. When we move to a lower low, there's a good chance that I should be taking profit, right? Because we know the probability when you move from here to here is that you can bounce. Sure enough, you bounced. So when we're looking at a market, it's okay to be thinking about where's the edge, right? But what you don't want to do is start what I call scenario building and getting into that mental state where you have to, you're searching and searching for certainty, right? Which doesn't exist. So you're trying to find, I just always know a novice trader is someone who's not there yet, who's not consistent, because they're always looking for something that either works all the time, or they're constantly trying to figure out, I need to look at this, I need to look at more at this because I want to figure out if I'm going to be right. All that's the wrong thinking. Because as soon as you set your expectations that I have to be right on this trade, or I need to know if it's going to fail here, you're getting in a mental state where you're not embracing the uncertainty, and you're setting yourself up for disappointment. And the problem with that is, in mentally, we have these mechanisms that try to avoid pain, and it happens on the subconscious level and the conscious level and the subconscious level. And you'll actually start to not perceive the information the right way. You'll actually, I mean, how many of you guys have been in the trade where honestly you fought the trend the entire way, and it's not until you stop out, right, that you realize, oh my goodness, this was the most obvious trend. If I'd have just flipped and gotten short instead of fighting it the whole way, I would have had a good day. Well, that's part of what's happening, is that your mind is blocking out the information that's telling you you're wrong, because with all those emotions that come with being wrong, or having those weren't your expectations. When you took the trade, you thought for sure the market's supposed to bounce, right? So anyways, I'm kind of digressing a little bit. Let's get back to some of these bigger picture concepts. Andrew, do you guys still have this trade on? Are you still in dollar Swissy? I'm just curious what you guys did on the euro too. Did you guys stay with that one? Yeah. All right. So what is it? Let's think about this probability stuff some more, guys. What does it actually mean to think in probabilities? And why is that essential to your success as a trader? I mean, how are you going to produce consistent results if you really think that every outcome is uncertain, right? And that's what we're talking about too. So we talked about the casino's edges, and what we want to focus on the macro level is not, again, it's just we want to take enough edges with the right risk parameters that we know that over time that's going to help with your consistency. All right. And I want to talk about this idea of not knowing, not needing to know what's going to happen next, because it ties into the expectation. So hold on a sec, guys. All right. Sorry, I was just looking at this position. You close euro, correct? All right. All right, so let me ask you guys, how are you guys doing on that idea of expectation? Yeah, the cycle is low. Yeah, no, I agree. Okay. All right, so I mean, I just get asked this a lot. It's always, what do you think about the market? And it's okay to have an opinion as far as what you think about the edges, right? What do you think? I mean, I say it a lot. Well, we could get up to 52, 53. I think you'll make a lower high, but the real belief that I have is that I don't know what's going to happen, and I don't need to know what's going to happen, because the moment you start either getting too confident thinking you know exactly what's going to happen, you are literally going to set that expectation, and when the market doesn't start to fail where you think it is, you're going to block it out mentally. All right, or you're going to consciously start to make excuses. You'll start to look and say, oh, I got this trend line over here. You'll totally start to justify, which is neutralizing your expectation where you're getting let down, because that doesn't feel good. I mean, anytime we have expectations and those expectations get met, you feel good, right? Anytime you have the expectation and they don't get met, there's that feeling of dissatisfaction, anger, frustration. And so for a trader to really get to that point where they don't, it's just, you go with the flow, you're in the zone, is you just have to get to that point where you completely let go of needing to know what's going to happen. And you actually want the mindset that I completely embrace the fact that the probabilities here, it's so hard to predict what's going to happen because I have no idea who the players are, who's in the market. Everybody's, I mean, it might look like the same pattern as last week or the week before, but everybody that's in the market today is completely different than last week or last month. So each individual event, or what you call we call in the now, right? In the present, you have to realize and embrace the fact that right now nothing is as same as it was last week, or when we were at that certain level, when the Fed was doing that, etc. But that's really the difference in the consistency that I see in a lot of, especially the beginning traders, always wanting to know what's going to happen, always needing to know more information, searching and searching and searching. Does that make sense to you guys? So when you think in terms of those probabilities, and the probability is I have no real way of knowing whether the market's going to fail 52 or 53, then you don't have a dilemma. You're not constantly trying to fight this dilemma of I need to know, I need to know, I need to know. And it's, when you think about it too, there's just the probability thinkers, they realize that there's no negative energy surrounding any particular market event. You're just projecting your emotions on whether the market's going against you, you're losing. All that is just in your mind. You're projecting that on the market. So that's pretty much at the core what every trader struggles with, is the expectations about the market's behavior. So that's why you want to be rigid in your rules, like we talk about, Rigid in your rules, rigid in your stops, rigid in your method of entry, your trailing stops, all right? But then you want to be flexible in your expectations. And most traders have it completely backwards, like we talked about. It's just they get in the trade, they move their stop. It starts to go against them. They know they're right. They start to look for other reasons why it's going to be right, right? I mean, you guys have probably done these things too before. So that's being rigid in your expectations and then just being flexible, throwing your trading plan out the window, all that stuff. It's just, it happens very easily, but it's just those beliefs can be pretty damaging. Yes, give me a second, 1 second. All right. Anyway, guys, what else? For those of you that are here, I mean, what questions do you have about that? I mean, um, any topics along those lines, mental analysis you want to comment? I mean, when I was in school, it's just like the lecturing is just, I was never a big fan of that. So I don't feel like feeling like I'm talking at you guys. So interaction's better. Um, somebody's asking me a question over here. Get questions about setting up the model and the bands and things like that. No, I don't have any videos on how to set up. I mean, we talk about that in the room when you join the team. These moving average bands, you can set them up. I mean, I like it on Thinkorswim because it does it for you. But these moving averages, you can actually set up and distance them accordingly. I don't have the numbers right now, but I can get you that on the team level. So anyway, guys, I mean, there's lots of things to work on when it comes on the mental side. But the biggest thing is to be journaling. And when you're journaling, then you're first of aware of how you're feeling about it, what you're thinking at the time when you're in the trade. But it just comes with experience. I mean, I know that there's been lots of times where every time I've tried to fight a trend, it's because I have a certain expectation. And you think that trend's going to break down, it starts to break out. And then if you're not able to just say, you know what, all right, something else is going on here, we're above the high, the cycle's turn, I'm just going to go with it, you end up fighting it and fighting it and fighting it. I mean, especially on the higher time frames. Like I think about that on euro pound up here. Let's see. Let me hide these signals. right. Getting up here on euro pound, I think we're probably going to get a lower high up here. Each time the market gets up here, you tend to make a long-term lower high. But you can't just start laying into it because that's what you think, or because, again, because we were up here before, that you build into your mind that that's what's going to happen. So we got to use the signals to make sure that, okay, you know, we're still early. We don't have a monthly cycle cross yet. We're still waiting on a weekly cycle. Those things will help you with the mental piece, but it really comes down to just kind of working on it as you're trading is, and watching your vocabulary too. I mean, a lot of beginning traders, they'll say those things like, I know it's got to go down. It's got to go down soon. It's, you know, it's definitely going to fail up here. All those things will suck you into the mental side of building an expectation. And then when it starts to move against you, you're totally oblivious to the fact that it's clearly an uptrend, or you broke to a new high, and then you just fight it. And that's how you take the big losses. But anyway, we'll do more work with that. Let's see. I don't know. I'm just going to go into the details then of the program because I'm not getting a lot of feedback here. I guess I'll share this with some of you. You guys on the team, have I gone over the 3 sigma rule before? Andrew, you probably heard it, the 3 sigma rule. And Craig, Rio. All right. I used to work with some of the buy side guys and a couple hedge funds on this, but so 3 sigma rule is, it's in statistics. So I showed this earlier. So you guys know this is the distribution, normal distribution. So different data points will lie right within this bell curve. And so in statistics, essentially within three standard deviations is where most of your data is going to lie. And this is why I like using the regression channels. When you guys see me draw the ranges, and you can draw the ranges for the near term, you can draw for the intermediate term, you can draw it for the long term. But they work really well because it's going to capture most of the data. So I don't like really using the average true range, or even drawing the trend lines doesn't work as well as the regression channels. I'll show you some examples in a second. But so this is the mean, right? And when you draw the regression channel, so if you have your stock like this, you draw the regression channel by dragging it over the price action, and then it'll automatically throw the channel on there, right, with the mean. So the mean's obviously in the middle. That's represented here by this. And then so out from here up is 1 standard deviation, 1 standard deviation to the downside. And then you can change these lines, right? So you can make it 1 standard deviation. You can make it 2 standard deviations out to here. All right, that's 2 standard deviations. And then 3 is obviously out to here, right? So what this reads is that 68% of the data is going to fall within 1 standard deviation. Okay. So price action 68% of the time will kind of fall within 1 standard deviation, right? 2 standard deviations, you're going to capture 95% of the sample size. And then once you get out to 3 standard deviations, you're going to capture 99%, 99, almost all of it, right? And that's what they call the tail, like black swan or tail risk, something that just comes out of the blue that maybe only happens once every, pick your number, right? 500 years or 50 years. Those are the tail risk. That's what they call that. And you hear that in people talking about markets. And so obviously we know in trading, yeah, you can go outside of 3 standard deviations. I mean, there's a couple times, if you guys remember, I think it was in January 2015, Treasury market had this weird, just had this weird move. They called it the flash crash in rates. It was after that flash crash that happened in stocks. And then there was one on the rate side in the bond market, and bonds went crazy. And there was an 8 standard deviation move. I measured it on the 30-year. But the way this looks, and you can draw these things, you can pick your market. I mean, what market you guys want to look at? Euro. Well, let's just do today's stuff, like on the near term. Is this new? Is this new for you, Craig? Can you see where I'm going with this one? So you take these regression channels, and then when you find a high, like you look this morning, all right, there's the high, and this is the trend that's been going down. You could see that pretty much captures, right? This is just 1 standard deviation, defaults to it. Okay. Yeah, so in trading, I mean, we know that you can stretch outside those blocks, obviously, right? Because again, the mindset needs to be anything can happen, anything can happen, anything can happen. Like that'll keep you from getting fixed in your mental projection of what you think the market's going to do. And the other thing with trading is you could stretch to a really oversold situation. Like 2 standard deviations might look like this, 3 standard deviations might look like this. But typically it's very hard to stay there, especially if you do it in a manner that's pretty violent on the way down. It's tough to stay there, so you tend to bounce back up towards the mean. But anyway, there are times where you can stretch outside of it and then kind of go sideways and then make another move down. But it's helpful for picking the ranges. Like I made that call that the euro was a long-term high just by doing this monthly regression. You can see how high we are within the range up there. That's 2 standard deviations actually. What am I doing here? Yeah, so you guys should use these. These help with especially like longer term. So we held at bottom of the regression here. Each time you've been up here, dollar's been overbought. And now we're back here. It's like, that's why I keep thinking we're a good chance we're going to get a higher low here, big picture. Anyway, you guys get the point. So I'll just, for those that might be new or kind of hanging around, I'll tell you a little bit about our full access team, how that works, and then I'll give you a couple slides from what you learn in the model just to take a look at real quick. So if you guys go to jenkinsrm.com, that's our site. There's a little bit about me. Here's our services. But you can get a free trial, and you can come in the room and see us trade live together. And the idea behind the full access team is I'm going to teach you this model that I built over the last 10 years trading institutional treasuries. And some of the origins of the model, I'll bring up the slides for that too. All right. So again, I talked about the time components. We get into, why the market cycle. Everything, space and time. We're inside that dimension of time, and it matters. So there's a rhythm. There's an oscillation, just like a metronome, right? And so we use those to help us trade even intraday on the 1 minute and 5 minute time frame. But these waves and these cycles, they exist. There's a business cycle at 8.6 years. I've showed this slide a lot. This is real estate. We topped out in February 2007. You had a minor move here. This is the Dow Jones Real Estate Index, top to the exact month of the business cycle. Just amazing. That tends to happen when you have capital concentrate in one sector, and it's got to be international capital too. To really have a bull market in something, you got to have capital pouring in from all over. But that's where this uptrend really started here in November. And then it's just 4 years, boom, right into the high, failed. And then this oscillation of time, and then right here, with this turning point, boom, you had the low real estate bottom. I don't even know where this index is now. Let's see. So there's lots of examples like this, guys. I do even events as far as other markets. Equities bottomed April 1994. At this turning point in 97, the Asian currency crisis started. Even the exact high in the Dow was in 1998. I have that on a slide also here. Where's that? I'll come back to that. And then on this side of the wave, on this side of the business cycle, that's when bad things happen, right? You had Russia, long-term capital management blew up. On this wave, you had the high in the NASDAQ, and then the stocks bottomed into 2002 with the low of the business cycle. Talked about the high in real estate here. Sovereign debt crisis was in 2009, and then commodities peaked. So this was a cycle inversion. So you can have some market peak with the low in the cycle. That's what happened with gold. If you guys go back and look, that was the high in gold, 2011. So everything's connected. But these cycles, they've existed since the beginning of time. So here you had the run up during the Roaring 20s. I don't think a lot of people have the data on that chart, but I overlapped the two. And so these dates are known. This is just an 8.6 year frequency straight across, but that was the high, September 1929. You had the market turn back up and break out again in 1934. And it didn't quite run to 1938, a full 4 years, but you did peak out and turn with that minor turn there in 1937. Anyway, guys, this is some of the stuff that we talk about when we learn the model. A lot of things around pi. Pi is really fascinating because when we look at the wave structures and a lot of the moves in the market, they do They're very similar to a sine wave or cosine wave. That's all derivatives of pi. So anyway, it's a lot of experience, a lot of time going into this and understanding, putting the two together. So you got to have the risk side. You got to have the, you don't know how to execute when you do see an edge. You got to think the right way when you're in the trade. You got to kind of all put that together, but that's what we work on the full access team. It's a 3-part model. So that's what I teach you guys: analysis, execution, and risk. And I think that's pretty much it. Anybody else have any questions? If you go to go to jenkinsrm.com. It's free guys to get in here on the chat room. I'd recommend you do that. That's a great way to interact with us. I'm happy to answer any of your questions. That's where we are every day. And other than that, guys, that's pretty much it. I got some more trades to clean up here into the close. Kind of a little bit behind on stuff today. Anybody new that has questions? Alec, if you guys see anything that I can't see, like on the socials, you just put it in the room, I'll answer it. All right. All right, guys. Well, enjoy the rest of your trading day. Look forward to seeing some of you in the room. All right. And you can follow us on Twitter too if some of you guys like doing that. It's at the jasonjenkins.com. Yeah, at the Jason. I'll type it. Yeah, at the Jason Jenkins. Yep. All right, guys. Look forward to seeing you someone in the room, and just hit me up when you get in the chat room. That's the easiest way to reach out. All right, Craig, Rio, Andrew. We'll talk to you guys in the morning. Okay, guys. Good stuff. Talk to you.